we're just a couple minutes away from a key decision on interest rates for the Bank of Canada. Charles St-Arnaud is chief economist at Alberta Central and a former Bank of Canada economist. He joins us. So we'll get this decision in just a couple minutes. And obviously, most of Bay Street is not expecting a move on a change in policy. What are your expectations?
Expectation pretty much with the rest of the crowd is that I don't expect the Bank of Canada to change the rate today. And they've been kind of clear for the reason why when they had the meeting in June is that they're more concerned about where inflation is and not necessarily the headline inflation, which is at 1.9%, more the core measures would have been running above or slightly above 3% over the past few quarters. So they're a bit of worries there.
And I've heard a lot of people saying that there's various factors for that sticky inflation, but the governor of the Bank of Canada himself, Tiff Macklem, talked about higher goods and food prices being one consideration. What is the inflation challenge for the BoC?
Well, the inflation challenge is more that I feel they have close memory, or we've had a very recent episode of high inflation in Canada in 2022 and 23, and the Bank of Canada clearly doesn't want to repeat such an episode, which was quite negative for the Canadian economy. So they want to be more cautious and ensure that they are really, or there's clear sign that inflation is moderating back within their target before considering putting more stimulus.
We should be getting that decision in just about a minute's time, but I guess the other consideration is just the resiliency of the economy. Some people feared the worst on the trade front. It's an ongoing file, but even if you look at the jobs report in June, that obviously would have to be another consideration for the BoC.
Yeah, well, I think the way I'm putting it right now is that the economy is no longer deteriorating. We're no longer in the situation in April, May, where the uncertainty was so high, the shock on confidence, both on businesses and consumers, was so big that we are seeing a lot of delay in spending. But now we're seeing a recovery in that confidence, and that will kind of provide some floor to the economy. Doesn't mean that we'll have a big rebound, but at least we're no longer deteriorating.
All right. So we have that decision, and we'll get to the right now, Charles. The Bank of Canada leaving interest rates unchanged with its latest decision, citing uncertainty posed by the U.S. tariff story. However, the Bank of Canada is keeping the door open to more cuts if the economy weakens and if inflation pressures stay in check. The governor of the Bank of Canada, Tiff Macklem, saying there are reasons to think that the recent increase in underlying inflation will gradually unwind, and that the recent appreciation of the Canadian dollar is a consideration in this story as well, in that we have seen a reduction in import costs. Let's take a live look at what's happening with the Canadian dollar. Just to reiterate, folks, the Bank of Canada holding its key interest rate unchanged at 2.75%. That was expected, and that is the third consecutive meeting that we've seen the BoC follow down that path. Keep in mind, as the currency market reacts to this, that it's also a day where we're getting a decision from the U.S. Federal Reserve, and the Fed is also not expected to make any changes, but we did get some, at least in the short term, some stronger than expected GDP numbers. Now, for the Bank of Canada story, obviously the assessment of the economy in the eyes of the markets is going to be seen as striking a more dovish tone. This opening statement from Tiff Macklem suggesting officials aren't convinced that the recent run-up in core inflation pressures will persist, even though they're not yet sure how this story of higher tariffs will filter through to consumer prices. Let me read you a quote from Tiff Macklem saying, boiling it all down, there are reasons to think that the recent increase in underlying inflation will gradually unwind. And I think I made the point about the appreciation of the Canadian dollar and what that means in terms of import costs. That's something that they're continuing to watch. Labor expenses in the eyes of the bank have moderated as you've got more available workers. Now, Macklem said there was a, quote, clear consensus on the bank's governing council to hold the policy rate unchanged, which is obviously one of the considerations. What do all the officials think about the situation? And to, quote, proceed carefully. But obviously, this story of tariffs is unresolved, so officials are watching what happens Do we get a trade deal? What does that mean in terms of demand for Canadian goods? Does it spill over into business investment? What happens with household spending? What happens with employment? We were just talking about the fact that you had a better than expected jobs report recently. And so even though we've seen these signs of resilience so far, the bank is noting that there is slack in the economy that has increased since January. I want to bring back Charles St-Arnaud as we continue to digest all of this. He is chief economist at Alberta Central and former Bank of Canada economist. So what would you say the market's overall takeaway should be in these first comments from the bank today?
Well, I think the first kind of general is that it's really the Bank of Canada, it's their view on inflation, because that really will dictate whether or not they can or they will cut rates again this year. And it's clear that they're in the camp that what we're seeing in terms of stickiness in inflation will be temporary. I agree with them. It's some of the factors that explain that. I feel a lot of what we've been seeing in recent months is kind of delayed impact of the pass-through from the very weak Canadian dollar we had earlier this year. We had a sharp depreciation in January, February, and that's still making its way. And then adding on top of that, the impact of the tariffs is making its way in the economy. We've also seen, and partly because of the weak dollar, food prices have accelerated quite a lot in recent months. So with the appreciation of the Canadian dollar in recent months, we could see some reversal. But we'll have to see if that really happens, or if we continue to see stickiness. If it continues to be sticky, I think the Bank of Canada might decide to be on hold for longer. When we go on the outlook, it's clear that yes, and I agree with them. They're still seeing some slack in the economy, but as I explained, I think that slack is no longer increasing as fast as we saw in the spring. And that gives them a bit of a breather to better assess in which scenario are we. Are we just in a slowdown, or are we in something that it could be worse? And it gives them also patience to see what happened on the trade front, and does Canada get a deal with the U.S. in the coming, even today or tomorrow, given the deadline is tomorrow, or in the coming weeks.
Right, and they have laid out multiple scenarios as a result of that. So no easy task to know, and obviously a lot of hedges that they have to conduct to try to figure out what they're going to do depending on the scenario. One thing that was interesting to me in the statement from the Bank of Canada, and if you're just joining us, the Bank of Canada has decided to keep rates on hold at 2.75% for a third consecutive meeting. One thing in the statement, Charles, that they mentioned, I would say more than mentioned, that they downplayed that jobs report we were citing in June when there were basically 83,000 positions created, easily surpassing what the expectation was on Bay Street. And I wonder if you're trying to at least keep everybody's eye on the possibility of a rate cut by the end of this year, playing down that recent jobs report, which is so quickly cited when people talk about the resilience of the economy, is interesting to me. And I only bring all of that up because we were having a conversation earlier in the broadcast about how Bay Street's expectations for further rate cuts this year had come down quite substantially. I think there was a reasonable number of people, based on everything we had been hearing, that would not have been surprised if we didn't see any more rate cuts this year. So I guess this is sort of preparation coupled with various scenarios depending on how things play out from here.
Yeah, well, I think when we come to the job report, I think we always have to be careful. The job report tends to be volatile. Sometimes you have a big outsized number, either on the upside or the downside, that happen and kind of break the trend, and you have to wonder. So for me, until we get the new number next week, it will be hard to see what is really the underlying story. However, the strong number, when you put it in the context of the whole year, still makes a weak labor market, but not as weak as what was expected. It's kind of make more of a flat labor market so far this year. So which is a bit more in line with kind of what we saw on the economic activity side. And that's why I kind of been focusing a bit more on what's going on in confidence. Like we've seen a rebound in business confidence. We're seeing a small rebound in consumer confidence, or at least we're seeing a bit more that, or a floor being put on the economy. I think that probably matters a bit more. And what the Bank of Canada is really trying to communicate is there's probably going to be some more rate cuts this year. My view is that there's probably another one, but they don't want to say that they're in a rush to cut. They just want to gather more information, see how the economy is really behaving as we see the initial uncertainty shock of Q2 kind of dissipate somewhat, and see how does the economy actually rebound from that. Is it just as I expect, this will be a relatively slow rebound, or we kind of stall and not actually have an improvement?